Are you tired of seeing a huge chunk of your paycheck go towards taxes? Are you looking for legal ways to reduce your tax bill and keep more of your hard-earned money? If so, you're in the right place. In this video, we're going to share with you 7 of the best strategies for legally avoiding paying taxes. From tax credits and deductions to tax advantage accounts and investing in municipal bonds, we've got you covered. So grab a pen and paper, take some notes, and get ready to keep more of your money in your pocket. Strategy number 1. Contribute to retirement accounts. Contributing to your retirement accounts is a great way to reduce your taxable income. As mentioned earlier, traditional IRAs and 401ks allow you to contribute pre-tax dollars, which lowers your taxable income for the year. For example, let's say you earn $50,000 in taxable income this year, and you contribute $5,000 to your traditional IRA. This means that your taxable income for the year is now only $45,000. This not only helps you reduce your current tax bill, but also helps you save for retirement. One thing to keep in mind is that there are limits to how much you can contribute to these types of accounts each year. For 2022, the contribution limit for a 401k is $20,500, while the contribution limit for a traditional IRA is $6,000. Strategy number 2. Claim tax credits. Tax credits are a great way to reduce your tax bill, as they provide a dollar-for-dollar reduction in the amount of tax you owe. There are many different tax credits available, including the Earned Income Tax Credit, the Child Tax Credit, and the American Opportunity Tax Credit. For example, the Child Tax Credit provides up to $3,000 per child under 18 for eligible taxpayers. If you have 2 children under 18 and are eligible for the full credit, you could reduce your tax bill by $6,000. To claim tax credits, you typically need to meet certain eligibility requirements and file your taxes accurately. Some tax credits may be refundable, meaning that if the credit exceeds the amount of taxes you owe, you can receive the difference as a refund. Strategy number 3. Itemize deductions. Itemizing deductions can be a powerful way to reduce your tax bill, especially if you have significant expenses in certain categories. Deductions are essentially expenses that can be subtracted from your taxable income, reducing the amount of taxes that you owe. Common deductions include mortgage interest, charitable contributions, and state and local taxes. If your itemized deductions exceed the standard deduction for your filing status, it may be beneficial to itemize your deductions. For example, let's say you paid $10,000 in mortgage interest, $5,000 in charitable contributions, and $5,000 in state and local taxes last year. If you're filing as a single taxpayer, the standard deduction for 2022 is $12,950. However, if you itemize your deductions, you can deduct the full $20,000, which would reduce your taxable income by that amount. One thing to keep in mind is that not all expenses are eligible for deductions, and there are limits to how much you can deduct in certain categories. For example, the state and local tax deduction is capped at $10,000 per single filers. Strategy number 4. Take advantage of tax-advantaged accounts. In addition to retirement accounts, there are other types of tax-advantaged accounts that can help you reduce your tax bill. Health savings account, HSAs for example, allow you to contribute pre-tax dollars that can be used to pay for qualified medical expenses. Contributions to HSAs are tax-deductible, and withdrawals for qualified expenses are tax-free. For example, let's say you contribute the maximum amount of $3,650 to an HSA in 2022, and you're in the 24% tax bracket. That means you could save up to $876 on your tax bill for the year. Strategy number 5. Maximize business deductions. If you're a small business owner or you're self-employed, there are many deductions you may be eligible for that can help you reduce your tax bill. Business expenses such as office supplies, equipment, and travel expenses can often be deducted from your taxable income. For example, let's say you're a freelance writer and you earned $50,000 this year. If you spend $5,000 on a new computer, $2,000 on travel expenses, and another $1,000 on office supplies, you could actually deduct those expenses from your taxable income, reducing it to $42,000. It's important to keep accurate records of your business expenses and consult with a tax professional to ensure you're taking advantage of all the deductions available to you. Strategy number 6. Invest in municipal bonds. Municipal bonds, also known as munis, are bonds issued by state and local governments to fund public projects. The interest earned on municipal bonds is usually exempt from federal income taxes and sometimes from state and local taxes as well. For example, let's say you invest $10,000 into a municipal bond that pays 3% interest. If you're in the 24% tax bracket, the tax-free interest earned on the bond would be equivalent to earning 3.95% on a taxable bond. It's important to do your research and consult with a financial advisor before investing in municipal bonds, as they may not be appropriate for everyone. Strategy number 7. Take advantage of capital gains and losses. Capital gains and losses refer to the profit or loss realized from the sale of an asset, such as stocks, real estate, or art. If you hold an asset for more than a year before selling it, any profit is considered a long-term capital gain and is taxed at a lower rate than ordinary income. If you sell an asset for less than its original purchase price, you have a capital loss that can be used to offset other capital gains or up to $3,000 of ordinary income each year. For example, let's say you bought 100 shares of XYZ stock for $1,000 and you sold them a year later for $2,000. That means you have a long-term capital gain of $1,000. If you're in the 24% tax bracket, the capital gains tax rate is 15%, which means you would owe $150 in taxes on the gain. On the other hand, if you sold the same 100 shares of XYZ stock for $500, you would have a long-term capital loss of $500. You could use this loss to offset other capital gains or up to $3,000 of ordinary income each year. And there you have it, 7 strategies for legally avoiding paying taxes. By implementing these strategies, you can reduce your tax bill and keep more of your hard-earned money in your pocket. Remember, it's always important to consult with a tax professional before making any tax-related decisions, as every individual's finance situation is unique. Don't forget to subscribe to our channel for more helpful tips and information. Thanks for watching.